You got what I want, got what I want. You give me just one look and you know I'm good to go. You know I'm good to go.
Thank you for joining Minds of Commercial Real Estate. Today we have Kamyar Rezaie with AA Investments, principal and broker. Amir, thank you for being on the show.
Absolutely. Thanks for having me.
All right. Amir and I go back. We've done a couple of deals for Amir's clients on the investment side and on owner-user side. Amir, tell us a little bit about your company.
Yeah, so it's a brokerage company, but we also do syndications. So on the brokerage side, really focus on investment sales and owner users, as you mentioned as well. Syndications, we look for value add, particularly on the side of retail, multifamily, and ground up development. Right now, we're really focused particularly on covered land plays. So, it's been a long journey, and started the company about a year after the pandemic, after the shutdown. So, been about 3.5 years now. So it's been going well. Thank you.
We were speaking earlier how you were more, clients were more focused on the investment, and today they're transitioning. Let's talk a little bit about that, like what happened prior to COVID and during COVID, how the mindsets of investors were changing.
Yeah, absolutely. So I can say right when COVID hit, there was a lot of hesitancy in the market. And we started seeing deals that were trading for significantly lower, and we started also seeing clients that were walking away from large amounts of money that had already been released to the sellers. So there's obviously a lot of panic in the market, a lot of uncertainty, a lot of unknown. We did hit a very small window that first year in 2020 where I would say prices probably dropped about 30%. And then the momentum kind of came back. That said, we got a decent amount of activity kind of starting to roll in, I would say, towards the middle of 2021. But there was still a lot of uncertainty that happened. 21 into 22 was really, really strong up until about June. I would say towards the beginning of third quarter 2022, things started to change a little bit as the interest rates start to really slowly ramp up. And back then, I think we were in the fog and the haze of, interest rates are never going to change, and this climate's going to stay here forever. But things did change. They changed very, very slowly. And so towards the middle of last year, I would say probably by June or so of 2023, activity really started to dwindle. You're getting essentially no movement on cap rates, and the interest rates have, for all intents and purposes, doubled. And so no deals are making sense. Sellers that don't really need to sell are going to sit there and enjoy it. And the challenge of that is when you have sellers who are sitting with, either really low leverage or a good amount of leverage, but the interest rate is low and it's not due for a while, there's not a whole lot of pressure to sell. So you kind of created this perfect storm towards the end of last year where everybody was just sitting on the sidelines, just waiting. And I think even since the beginning of COVID, kind of rewinding a little, everyone's been waiting for quote unquote blood in the water. So there is a huge amount of cash and capital sitting on the sidelines, even till today, waiting for that. Now, start of 2024, we did see some actual decent price movement. Interest rates had come down, particularly from about November of last year. But we started to see those also start to go back up and up and up. And we're waiting for the Fed to cut some rates and really get the activity spurred back on. But that's a quick little synopsis since the start of COVID, kind of what we've seen.
Right. We spoke earlier as well a little bit about how people were very focused on the industrial sector. It was a hot market, ups and downs, and right now it's not as hot. What's your thoughts on that?
Yeah, industrial. Look, industrial still white hot. Maybe it has a little bit away from the scorching white hot, but it's still pretty much white hot. It is a very, very strong market. The prices, I would say, in certain areas have tripled from about 6 years ago or so. We were mentioning and I do remember we literally worked on a deal that was a couple miles from the port, which is the strongest industrial, market, I would say almost internationally, but definitely in Southern California. We were working at a deal, we were negotiating, my client wanted to pay $151 a foot, the seller wanted 154. And now that building's probably around $4 to $450 a foot. So we've really seen a huge price increase there. We did hit a little bit of a speed bump, which is what we were chatting about. I think tenants just put their arms up and said, hey, look, we just can't afford these rents anymore. So it did hit a little bit of a speed bump there, but overall, historically, the industrial market in Los Angeles is sitting at 3% vacancy, and most of that vacancy is, product that nobody really wants to use, right? It's like metal warehouses and stuff like that. So you really essentially have a 0% vacancy, but there is that threshold of what tenants can pay or what they can't. It's still, till today, I think remains the strongest market segment in commercial real estate in Los Angeles.
Okay. In terms of, we do, with these higher interest rates, we are seeing a lot of movement with the owner-user buildings, obviously, and people are just want to own their own building, not have to deal with the yearly increases, and get a little bit more on the, rates that are more stable for them.
Yeah.
And the more important factor, which is a lot of people who are buying buildings nowadays are really using to their advantages as the point of cost segregation. Cost segregation in terms of accelerated depreciation can really help them in their, paying less taxes in the beginning years of when they own a building. And so even though we're looking at the rates of, let's say 6 to the 7s today, but with the factor of cost segregation, you're seeing these buyers of buildings, either owner user or investment commercial, are seeing it still into their advantage.
Yes, definitely.
When you're like dealing with a client that's looking to purchase, does do they look at the cost segregation aspect a lot, or are they weighing more the rates versus the cap rate, the cash flow?
Yeah, great question. Cost rate segregation comes up with clients that are a little bit more sophisticated, understand kind of real estate a little bit more. I would say on owner users, we don't see that as much. But definitely, I would say the more sophisticated investors are going to take advantage of cost segregation, accelerated depreciation, as you mentioned, and really looking at the big picture of what's advantageous for me to do right now. Owner user is still incredibly strong in the market. I was mentioning to you, I have a couple owner users, and just it's a dearth of product, and even that the ones who are in the office sector. Trying to dig up off-market deals is still challenging. Even going to that extent with how, I have to choose my words delicately, but how crushed the office market is, right? Like the office market is not doing well, and I don't see that changing. I think that's a fundamental shift, but with all of those factors, with the incredible amount of availability on the leasing side, with the lack of demand, owner-user product is just, it's not available. But to answer your question, I do definitely see that. They do take advantage of that when they're a little bit more sophisticated and understand how that works. And, my job is to get all my clients to understand little things like cost segregation and accelerated depreciation, all the various things that you can take advantage of.
The last 2 deals that we got in the last 2 weeks for clients of ours that we were providing finance for, they were off-market deals. I think a lot of people are just not really trying to put their deals out on the public, but in case they find a good buyer via a friend, referral or some sort, they're trying to they will offload it. And the reason for these 2 particular deals was because they had already used all of their depreciation, and they needed to basically buy new properties to get that accelerated depreciation cost segregation in play.
Yeah, definitely. We see that. It's really a position that you are deciding whether you want to sell. And I think that right now, anything that's moving is either going to need an aggressive price that's off market, right, to get the sellers to sell, or there is some sort of distress. And I think that distress is really going to start to increase. I'd love to hear it from your side too, but we are starting to see some of these loans approach maturity. And I think as they do more and more, there's going to be some people that are significantly underwater and or just can't afford, they just can't afford the debt with the new interest rates. So we're hoping to see that, but I think there's such a large segment of commercial real estate investors that are just sitting on dry gunpowder and waiting for that to come. But what are you seeing? Are you seeing that as well?
Definitely in 24 and 25, there are a lot of loans that are becoming due. I don't know the percentage versus the ones that have become variable versus balloon, but there's a lot coming. We've done a couple of deals where the owner has to have come in with money to be able to get the refinance done. And even in those circumstances, there are the banks that said, we don't want this deal. Even if the client coming in with the money, we don't want to sit on this asset. So clients that are sitting on cash and are able to come in with the cash to keep their properties will be able to maintain and will be good for the long term. But there are a lot of clients that are over leveraged. Yeah. They don't have the cash to come in. And when they put it on the market, for one reason or another, people know that they're in trouble, so they're not making offers up front. So it's getting to the last second. The balloon's coming due. They have 90 days to pay it off. Yeah. They can't even go hard money on it. So unfortunately, bad circumstances are bound to happen. And I think we will see a lot of distressed properties in 24, 25 that will change hands.
Yeah. The hope is that, and obviously you never want to see anybody, be in a position of distress, but a lot of people took very unnecessary risks and did not, forecast the potential for that. I'll give you an example. We underwrote a deal that we had with a client, and this was a deal that I was going to be on the principal side with them. At the beginning of the year, we underwrote the deal with a 30 basis point increase in interest rates. And anybody and everybody who looked at us said, you guys are insane. What are you doing? The Fed's going to be cutting the rate 4 to 5 times, a point to a point and a half. It's already trending down. Why are you guys even doing a 30 basis point increase? And as we were discussing, there was obviously a little bit of a jump all of a sudden. And at that point, when that jump hit, we were actually 50 basis points below with our 30% increase during that little increase. So things happen, and you have to have the foresight in order to not get in to a situation that many owners are right now. And I do think some of this is going to come to fruition, and I think I agree with you. 2024, 2025, we're going to really start to see some pain in the market, and I think the sophisticated buyers, the ones who have been patient and have been waiting for all of this to come, are going to be handsomely rewarded at some point with this.
Yeah, I mean, prior to COVID and even during COVID, well, maybe not during COVID, but after COVID, there was a lot of CMBS deals. Yeah. They got the 5, the 7, the 10s. I mean, those are necessarily not coming to fruition right now, but when they do, depending on what the market is, they can be hurt.
They can be very hurt, and I think it's a dangerous game to try to forecast. As I said in my example, It's a very dangerous game to try to forecast where interest rates are. You got to be conservative, take the worst case scenario, and if you win, you win. But if you lose, you're really not, right? Because you're hitting at your base case scenario.
Right. Let's get a little bit on the subject of the multifamily. We're seeing different counties, different cities with different leverages and different rent increases for the multifamily. What do you see out there?
Multifamily is an interesting one, right? It's I've often referred it to multifamily as kind of the gateway drug for commercial real estate. It's at some point everybody's familiar as soon as you say real estate, I think the average person thinks of single family and a house, and but so everybody has experience with that, right? You've either lived in a house or you've rented. You got to live somewhere, and so multifamily, you get a lot of newer investors into commercial real estate. So you have a extremely wide spectrum of ownership, from literally mom and pop, where it might be they own a duplex and that's the only thing and they live in one of the units, all the way up to institutional groups that own, hundreds of thousands of units. So we are seeing a really interesting phenomenon in I would say Southern California, as you brought up. The different municipalities have various laws. California as a state has a lot of laws that regulate rent, growth and increases. And a lot of the investors have really started to move away from that. I would say investors that have been here for a really long time, just seeing some of the laws, some of the extremely tenant-friendly laws that have been passed, have really, really persuaded a lot of owners to begin to move out of state or out of those municipalities that are there. It's definitely having an impact. I mean, I'm seeing a lot of these deals. I always try to do my due diligence with to see why the sellers are selling, and it's been an uptick. I mean, the past 2 years or so, you're starting to hear a lot more owners saying, "Hey, we want to get out of California, or we want to get out of multifamily in California, and really kind of divest into retail or industrial or other things." And a lot of that money is going out of state to I would say a lot of the Sun Belt states. A lot of money has gone into Arizona, Utah, Nevada, Texas. They're really picking up a lot of California investors, but it still remains strong. With all of that said, multifamily is still extremely strong. Good product is still selling at really low cap rates. Rents are still going, higher and higher every day. I always look at it and say, if you have a niche product in a good location with multifamily, you're never going to lose. One of the deals that you did the financing for us, we were just chatting about it. It's in Venice. It's
It's great property.
it's phenomenal, right? And we underwrote it with 2 of the units thinking they're at market, and we hope they don't leave. Within the first 12 months, they left, and we were like, oh boy, what do we do? We're up 20% on each of those units in rent, and so it that tried and true thing of location is really important. But we are seeing definitely a divestment from a lot of ownership out of California, and hopefully the governments take a little bit of notice. I want to be clear that I do think there has to be tenant rights, and I do think there's a lot of landlords who just they don't.
Unfortunately.
Yeah, they don't really treat their tenants really, really well. So I completely understand that. But, there's also just some draconian laws that have passed. And ultimately what that does is it really hurts the tenants, because you get worse ownership, you get owners that don't care, you get worse product, you get, product with deferred maintenance. And that doesn't help tenants ultimately, right? You want safe, good, livable spaces. And, I didn't mean to diverge that much, but it's really important that we look at these issues from every aspect, not just one, and to realize that in Los Angeles, it's not always this big bad wolf of the landlord. Roughly 90%, and this is a number that usually blows people's minds, 90% of owners of multifamily in Los Angeles own 5 or less units. And so that, when you say that, you realize that when you're trying to create this really false divide in my mind of landlord and tenant, you're creating these people who are these awful, mean, money-hungry, horrendous people. And oftentimes it's another person who owns this thing. And it's been difficult, but hopefully some of those things start to change.
Absolutely.
Yeah.
Final topic I want to hit on is the single tenant retail, the fast foods, any of these. What are you seeing in that sector?
It is hot. It's very, very hot. It's remained hot. I think we refer to them as coupon clippers. Credit is there. The debt's there in place for those. It's very long-term, easy, stable cash. cash flow for a lot of people. Personally, it's not something I usually advise unless you just have money absolutely pouring out of your pockets and you're looking for something that's equivalent to like a T-bill, right? It's just one of those that it's there, but the money's still chasing after them. You know, you get credit, and I'll just use McDonald's as an example, right? They're not going to go anywhere. The locations are usually phenomenal locations, and so people trade that for the lower cash flow, for the stability. You know, they have nothing to worry about, they have no concerns, and they just sit and, you know, relax and enjoy their cash flow. But it's definitely compressed. You're still seeing in good areas, the cap rates are still below 4, which is incredible to say. But it's still a very, very strong segment. Yeah.
Based on that, you know, those are usually triple net, you know, leases where the tenant pays for the insurance, the rent, property tax. There's like 0 or to 5% responsibility for the landlord.
Correct.
Which is a big plus.
Yeah. If you don't want the hassle of really being a landlord, the single net, triple net deals, those single tenants are just easy, right? Anything that happens is pretty much on the tenant. Correct. A lot of those, in a lot of ways, the leases are even written. If the building catches fire and burns down to the ground, the tenant literally has to rebuild your building. So you have absolutely no responsibility. And for a lot of people, that's
great.
Very attractive. Yeah. Yeah.
Well, Amir, thank you for being on the show. It was a pleasure speaking with you, and look forward to our next deal.
Absolutely. Looking forward. Thanks for having me.
Yeah. Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.
Let's get together. Let's get to having some fun. Let's do whatever. The night's looking so young. Let's get together. Let's get to having some fun. Let's get together. Let's get together. Let's get together. Let's get together.